Hi, my name is Aman and I'm a chartered professional accountant. In this video, I will explain the tax impact of refinancing and using your home equity with the help of Mark's story. Mark purchased a property 2 years ago for $300,000. The market was doing well and Mark noticed that the neighbor just sold a similar size property for $500,000. Mark wanted to generate extra cash flow to buy an investment property. However, he did not want to sell the property in order to buy the investment property. He wanted to find a way where he can still keep the existing property and still find the cash to make the down payment for the investment property. He also wanted to know the tax implications of generating money for the down payment for the investment property. Mark decided to consult with a chartered professional accountant to make an informed and wise decision. After studying the net worth of Mark, the accountant advised Mark that instead of selling the property, he should refinance the property. Mark was not familiar with the refinancing process, so the accountant explained that the refinancing process was very similar to the one he followed when obtaining his original mortgage. Mark's finances were verified and calculated, and his home was appraised to determine its value. In the end, Mark qualified for refinancing the property to an 80% loan to value gave him an additional $160,000 for his next investment. The chartered professional accountant advised Mark that he can only deduct the interest on money borrowed for investment in Canada for saving tax. So the accountant advised Mark that he should use the $160,000 for the next investment property. Mark liked the refinancing strategy for growing his wealth through real estate investments. Well, after years of appreciation on refinancing, Mark extracted a total of $400,000 from his house and he used this money to reinvest in other investment properties. He finally decided to sell the property for $700,000 and the mortgage outstanding at the time of sale was $500,000. Mark's capital gain was $400,000, which is $700,000 selling price minus the original purchase price of $300,000. Well, Mark was in the highest marginal tax rate, so his tax liability was approximately $100,000. As Mark chose to sell the property after paying off the bank and the government, he had Well, Mark initially loaned $60,000 to the corporation to purchase this property. You see, Mark wanted to withdraw $160,000 from the corporation. Well, $60,000 was tax-free as it was classified as repayment of initial investment. The additional $100,000 was distributed to him in the form of salary and dividends, which were reported on Mark's personal tax return. The accountant advised Mark that if he intended to invest the additional $160,000, he should invest inside the corporation instead of taking the money out of the corporation and having the tax consequences as discussed. As no money went directly to Mark's pocket, there was no immediate tax impact in that case. Mark now understood that refinancing compared to selling had a lesser tax impact, which helped him in debt consolidation and also get a lower interest rate as well. He had now gained clarity on how the real estate transactions need to be structured in order to save the tax dollars. If you want to be notified about our new tax stories, please consider subscribing to our YouTube channel. Thanks for watching and see you in my next video. Bye.